Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Shares in China gain after the nation's banks cut lending rates. European and US futures, though, look mixed, while Middle East tensions push gold to a record high. European earnings season shifts up a gear with some of the region's biggest companies across the banking, autos and tech sectors set to report this week. Plus, Tesla's CEO Elon Musk offers $1 million handouts in key battleground states as the fight for votes in the US election heats up. We'll bring you the latest on the race.
In the meantime, a quick check on these markets here. You are seeing futures tilt slightly lower. Underperformance in the Euro Stoxx 50 down to the tune of 0.2%. FTSE 100 virtually flat, but again, some outperformance here. The currency picture is interesting. You're seeing movement in the bond market. Euro dollar at a 108 handle, cable at 130.39. The countdown to the opening trade starts right now.
Monday morning, good morning. Here's the recap. US equities are at near record highs. We've been driven there by fantastic economic data. Retail sales, just the latest piece suggesting that the US economy continues to fire on not all cylinders, but close to all cylinders. This week, though, we get into the earnings story. We've got NatWest to Newmont Mining. We've got Texas Instruments to Tesla. We've got Barclays to Boeing. Boeing is going to be fascinating this week. A big earnings week. Does it crystallize this earnings story? Does it crystallize the story that equity markets continue to drive higher? We're going to wait. We're going to watch with interest. That's not to say, though, Anna, that there isn't macro data to digest.
There is a bit, isn't there? And that takes on a European focus. And so, yes, you're right. We've been really focused at the end of last week on the strength of the US economy. This week, perhaps we focus a little more on that transatlantic divergence and the weakness perhaps in Europe. We're going to get PMIs later this week. France, Germany and the Eurozone already in contraction when it comes to the composite numbers. This coming at a time where there's a lot more concern about fiscal spending, it would seem. We've been talking about that, Kriti, on the show a lot with guests, particularly in the fixed income space, and asking about treasuries. The IMF warning around that today ahead of their annual meetings, IMF World Bank meetings, talking about debt globally. Public debt, this is, could get to $100 trillion by the end of this year. So that'll be another focus as we watch for UK borrowing data, ratings on France, all of that, keeping the fiscal very much in focus.
I believe we get EFO data out as well at some point this week. And I feel like my question for the audience and for everyone involved is, how much worse can it get? And what is the reaction to it? In Germany in general, right? In the PMI data, you are seeing, as Anna pointed out, weakness there. What do you do with it? Or do you just kind of live in this existential, things are bad, and that's the way things are?
Well, I think you continue to price in more aggressive ECB rate cuts. That seems to be the narrative that we're getting right now. And that continues to be confirmed by all the ECB speakers that we are getting. And we're going to get many more of those this week. I think Lagarde speaks multiple times this week, so we'll hear from her as we work our way through this week. 20% of the S&P reports this week. That's 16 trillion of market cap that is going to be delivering numbers. A number of standouts. The defence companies, there's a lot of defence companies reporting this week. You've got Lockheed Martin, General Dynamics, these kinds of companies as well. We continue to obviously watch what is happening in the chip space post ASML. Texas Instruments is going to be fascinating on the back of that. You've got a whole load of European banks. Barclays is going to be reporting numbers. NatWest is going to be reporting numbers. I'm particularly fascinated by what is happening at Boeing. So Boeing's results in some ways actually the non-event Wednesday the 23rd. The reason for that is that you've got this big vote from the unions coming up later on in the day. You can't really determine what happens next with Boeing until you know the outcome of that vote. Are they going to continue with the strike? Are they not going to continue with the strike?
33,000 striking members. They've have picket lines. They walked out of factories. They've been that way for a couple of weeks now. 35% over 4 years. That's what they're asking for in terms of these wages. You're seeing a lot of labor movements around the world. I think this is probably the biggest ask we've seen among all of them.
And they have voted in the past against what has been recommended by union leaders. So the union leaders aren't even recommending this one because they've been burnt before on that. So that's in focus. Tesla, we also get numbers there. You mentioned, Guy, we get tech. We're going to get SAP later on today, aren't we? We get Infineon later this week. And just as a reminder, that is a sector that we have really been whipsawed around in terms of our sentiment toward, because we we sort of rode a roller coaster around NVIDIA and the expectations there, into ASML, into TSMC, and we're starting to sort of dissect tech into AI and the older tech themes, and that seems to be useful.
Jensen Huang is going to be speaking. I think there is a big NVIDIA event this week in Mumbai. Back end of the week, I think it's Thursday, we're going to hear from him, so that'll be fascinating as well. Infineon downgraded this morning at Morgan Stanley on the back of what is happening with the auto sector. It's really exposed to the auto sector. It's less exposed to the AI story, as you say. We're getting big divergence in the chip makers as a result of that.
So much of that in the corporate space is dependent, though, on what happens in just over 2 weeks' time, and that is, of course, the election. Election day in America, November 5th. We're 15 days away from that. And we're starting to see, of course, Kamala Harris and Donald Trump going door to door in some of these swing states. Pennsylvania seeming to be the make-or-break case for a lot of folks. Elon Musk playing an interesting part in all of this. Over the weekend, a super PAC of sorts, $1 million a day until Election Day for anyone who signs, or a potential voter who signs a petition for free speech, and the right to bear arms. Sounds pretty straightforward, except it's basically a lottery. Is this legal? We don't know, but certainly getting some attention.
Yeah, and certainly the Democrats are suggesting that there might be some legal actors might need to look at this. That law enforcement, I think, was the phrase used. Yeah, might need to look at this to see where this goes. We've got some really interesting stories surrounding the polling, really interesting stories surrounding the betting odds. Some people hate the betting odds, some people love the betting odds, but they're out there for what it's worth. And we have seen 4 very large accounts, it seems, according to other media, taking up a lot of that, taking a lot of the, putting a lot of the money into those betting odds.
Absolutely. How do you use them? I think we've all been burnt so many times recently by predictions of how election results,
see Brexit,
referendum results, call them really hard to figure out exactly what is happening, and this just further muddies the water. So there's lots to discuss. Big week of earnings coming up, lots of macro data. Today, Lawal is the head EMEA of corporate credit over at Barings. She's going to be joining us very shortly. Looking forward to that. Half past the hour, results of a 4-day work week study in Germany. Is it going well? Is it not going well? Is it delivering? What's happening with productivity? Carsten Meyer, managing partner at Entrepreneur, is going to be joining Ollie Crook out of Berlin. At the opening trade, Christian Mueller-Glissman, asset allocation research head at Goldman Sachs, Kriti, is going to be joining us. I want to talk to him about what's happening with this spread between the US and the United States when it comes to the equity story. It's absolutely epic right now.
I want to know how you price in some of this debt conversation. The deficit's about $1 trillion. It's getting bigger and bigger. Certainly a conversation over at the IMF and World Bank. The IMF summit beginning, of course, on Monday as well. Let's talk about what else is going on during the week, because we talked about how it is filled with corporate earnings on both sides of the Atlantic. We also got the BRICS summit on Tuesday as well. I believe we know now that Lula is not going out of Brazil, that due to a head injury. But we also do know, of course, the President Xi Jinping will indeed go to Moscow to attend that. So that's going to be one we keep an eye on. We talked a little bit about the macro data, global PMIs, the German IFO data at the end of the week. There's a lot going on. Fed Beige Book as well, snuggled in there somewhere. I wonder if we end the week where we started, which is it's about Election Day. That's where we're waiting. Is there much of a game changer this week?
Yeah, I mean, we see gold prices going higher, and yes, there's Middle East tension in there, but a lot of people saying there's also just nervousness around the election and trying to get through that. And so, yes, it does feel as if that point in the calendar, that point in the agenda, looms large.
But everybody still continues down this road of it's going to be a split government. We're going to have gridlock. You don't need to worry about the US election. People expected that actually what you wanted to do was be short particularly equities, short risk assets into the election. That doesn't seem to be the case anymore. People are taking those trades off.
They are, and I think, to your point, so much of it is that this is based on what Congress happens, what promises are made on the campaign trail may not ultimately deliver, which brings us to maybe what is more market moving, which is some of these tech earnings. SAP after the bell today, in the European close, after the European close today. But then next week, we've got the big tech earnings hitting the wire as well. Does that change the game? Does Tesla, does Boeing set a particular tone?
It's going to be really interesting in aggregate to hear what the CEOs have to say. There's some idiosyncratic stories in there. Certainly, I think Boeing is one of those. But nevertheless, kind of what are they hearing in terms of the macro story? What are they telling us about the macro story? What's really going on in the US economy, which seems to be still flying pretty high right now? What else do you need to know this Monday morning? Let me tell you, the Israelis have launched a military operation targeting Hezbollah economic strongholds in Lebanon, in particular a financial institution used by the militant group. The unit serves as Hezbollah's alternative banking system and allows the Iran-backed group to function effectively. The Moldovan president is on track to win the first round of this weekend's elections, but a key referendum on joining the European Union remains too close to call, a sign of the challenges the country faces in prying itself from Russia's grip. And Sanofi and CD&R have entered exclusive talks to transfer a 50% controlling stake in Sanofi's consumer health unit, Opella, to the private equity giants. The agreement comes after CD&R made commitments around local jobs, investments, production with the French government. The deal is set to be closed, we think, in the second quarter, of 2025 at the earliest. I think there's a French press conference. I think the government is going to kind of have a press conference a little bit later on today, laying out what commitments it's managed to extract in terms of protecting jobs, investment, etc. later today.
And that seemed to be what a lot of the conversations at the weekend were about, what kind of reassurance could be given, because we did see a late entry into this bid process, didn't we, from PAI, a PAI-led consortium tried to get in on the action, but eventually Opella, 50% of Opella then going to CD&R instead, as was, I suppose, originally being discussed and originally intended. But you had seen it got competitive just towards the end.
And you can see that the French government is really not only careful about how much of the controlling stake and what the requirements of this deal actually are, but the process in which it's bid, because you mentioned that late bid came in after the deadline, even though it was a juicier bid for Sanofi. It looked like it had better deal terms in it. The French government cracking down, saying, look, there was one government deadline, you didn't make it, therefore you're out of the race.
Sanofi upgrading their guidance, I see, this morning on the back of this. We need to tell you what is coming up on the programme then. Europe's second most valuable tech company, SAP, is set to report earnings later today. We'll dive into the details and discuss the wider cloud computing sector. Is it second? Sometimes it's first. Depends what's going on with ASML. Changes almost, day in, day out. Plus, is working less actually better? We'll bring you the results of a German trial looking into the benefits and drawbacks of a 4-day work week. Up next, we will be joined by Omotunde Lawal, head of EMEA corporate credit and emerging market corporate debt at Barings. Lots to discuss there in terms of, well, to Kriti's point about the election looming large. Do we see that in the supply, in the issuance calendar? If you have any questions, if you want to get in touch and be part of these conversations with our guests, join us around this table. Use the IB function. IB plus BBTV Go is the function to use. This is Bloomberg.
44 minutes to the equity market open here in Europe. Flattish trade expected. Certainly that is what the futures are signalling right now. But it's a big week for earnings, really big week for earnings. But let's not forget as well that you've got this political story that needs to be inserted into the narrative as well. The threat of higher US tariffs has become a major talking point amongst European CEOs. This, of course, after Donald Trump said he would raise import duties if he returns to the White House. Last week, the Republican nominee said tariffs was his favourite word. Here with more on this story and how this is playing out. Bloomberg's Valerie Teitel.
Good morning, Guy. I want to talk a little about the goods sectors versus the service sectors and the divergence we could possibly see in them in Europe if we do get these Trump tariffs. So just take a step back. This is a chart here. The blue line is the European benchmark, the stock 600. But these two are some Barclays indices, one being a relative EU goods performing sector, and the yellow line being those goods especially exposed to China. So they have lagged the broader benchmark in the last month, and ever since Trump vowed those trade tariffs against Europe. But we could see a further bifurcation of this, Guy, between the goods performing sectors, the goods producing sectors such as Germany versus the more service sector economies in Europe. Think Spain, think Portugal, think Greece. We could see perhaps a credit spread divergence between those two if we do get these tariffs coming from a new administration in the U.S.
Valerie, thank you. Bloomberg's Valerie Teitel with the latest on how tariff-exposed businesses in Europe might trade under another Trump presidency and how we're seeing evidence of that in the markets already. Let's talk to Omotunde Lawal, head of EMEA Corporate Credit and Emerging Market Corporate Debt at Barings. Tunde, very nice to see you this bright and early this Monday morning. Let's ask you about the credit story then and where you see evidence of US politics sort of playing in. Valerie was talking there about the way certain businesses are performing that might be hit by tariffs from the United States if we see Trump 2.0. Is that something you're seeing in evidence in the corporate issuance space, maybe companies, the pace at which they're coming to market or the way they're trading in the markets? Any nerves there?
Absolutely. So we definitely are seeing that. I think European corporate earnings kicked off in earnest sort of last week, and I think we've seen that coming through in the last couple of weeks as well, where we've seen the likes of LVMH, Kering talking about weak earnings, especially linked to China. LVMH spoke about sort of softness in their luxury goods product area, and Kering as well. We saw spreads last week on those two issuers anywhere from 5 to 9 basis points wider. We've also seen the same phenomenon playing out with the autos guys. You've seen BMW, you've seen Volvo, you've seen Stellantis. All these guys that have some sort of linkage to China are talking about that sort of weakness coming from China, as well as that hesitancy around tariffs. But I'd say that the flip side to that is you're seeing the Chinese government is also now sort of wheeled out a mini bazooka, not a big bazooka, but a mini bazooka in terms of trying to stimulate consumption and demand domestically as well. So that also has the sort of offsetting effects against the softness that the likes of LVMH and these luxury goods providers are seeing. And I remember a few months ago, I was on a panel with the LVMH CFO, and he said to me, there's a big difference between a Chinese buyer of luxury products and a China-based buyer of luxury products. And so the point he was making is, yes, the slowdown in domestic China is affecting some parts of their demand, but actually there's a huge amount of Chinese buyers in the diaspora who still are buying these luxury products.
And they travel as well.
And they do travel.
Right. And so, I mean, so the PBOC delivering, to your point, just this morning with a 1-year and 5-year loan prime rate cut. That's today's sort of effort towards that stimulation. It's interesting when I ask you about the tariff threat for European corporates, and the conversation goes to China, because it's difficult to perhaps untangle or disentangle the negativity we're seeing in European corporates around what they're doing in China and that sort of nervousness around what might happen with Trump. You know, we've got both of these downward forces.
Yeah, I mean, Trump, like Guy said earlier, he did say the tariff is his favorite word in the dictionary, which I thought was hilarious. But I think China in itself, I think if we do get a Trump win, I think China in itself is bracing for this. And that's why it feels like they've kept some bullets to spare against the inevitable tariffs that might come with a Trump administration. So I feel like, yes, if we get in day one, Trump puts the tariffs in, I feel like, one, we've seen this playbook before where he does the tariffs, and it's a bit transactional, and it's like, I'm going to impose these tariffs, but in exchange, if you want me to lift it or if you want me to reduce the impact, you give me this, you give me that. So I feel like the Chinese government has some sort of playbook in terms of how he operates. So it's a case of they have some bullets that they can play on their side to dull the impact, but then it's about what do you want from this. And similarly, I think the 10%, so it's a 60-10, right, and 10% tariffs on the rest of the world. I feel like Europe also has some bargaining chips in terms of it's going to be transactional. If I impose these tariffs, what do you need in exchange for me to lift it? And I think there's been conversations around higher NATO budget, higher NATO spending and things like that. So there's probably going to be a deal to be done where the initial tariffs that are announced probably aren't what plays out in the fullness.
There's a lot of talk in Brussels at the moment about a very big European response. So it could work both ways on the tariff front. What's the argument for owning credit right now? It's very expensive. Spreads are very tight. What is the argument for putting the marginal extra dollar to work in credit rather than somewhere else?
Okay, so that's interesting. So we had a fixed income conference last week at Barings, and one of the charts that we showed to prospective investors there was the trend of bond yields versus dividend yields. And actually, bond yields right now are much higher than dividend yields. So that's your first argument as to why you should own fixed income here, even though spreads
It's a yield argument.
It's a yield argument. It's you know, we're stepping away from the previously indoctrinated view that it's all about spreads, because right now, actually, all-in yields are very attractive. In the US, all-in yields are just shy of 5%. And in Europe, all-in yields are around 3.2, 3.3%. So those are still pretty attractive, especially as you're getting higher yields than the equity market. You look at history tells us also that actually, if you invest in fixed income right after the last Fed hike, then 12 months after that, 18 months after that, 36 months after that, you see positive returns as high as high teen returns in fixed income. So again, if you think history plays out, you know, now would be the time, despite credit spreads being tight, if you think the Fed is at peak rates, now would be the time to sort of deploy the cash if you're looking to sort of cap the upside that history tells us comes through.
Do we think the Fed's at peak rates?
I don't know. I guess that depends on how and affects how much further the ECB has to go. I want to ask you about the periphery in particular, simply because Valerie did actually talk about how you could start to see that divergence widen, but that divergence already exists. How much widening are we talking about?
So that's very interesting, the charts that she had there, and she spoke about the goods-producing economies versus the services economy. I think that's a part of the reason why we are seeing that divergence. You see, actually, on a year-to-date basis, you see Germany, you see France spreads about 15 to 18 bips wider. But you look at the periphery, you look at the Spains, the Greece, the Italies, they're anywhere from 30 to 50 bips tighter on a year-to-date basis. And I think that divergence can continue again, because if you think about the tension that's potentially coming from tariffs to China, tariffs to Europe, slowdown in China, domestic consumption, that continues to provide a sort of headwind to goods-producing countries. You know, there's only so much the BMWs, the Volvos, and all these guys can compete. But on a services perspective, actually, we see that, you know, there's a lot more resilience within the services sector. And so the likes of the Portugal and the Greases and things like that are benefiting from tourism and other things, they continue to show resilience. So we can continue to see that divergence. I think the numbers that we saw in terms of growth expectations for peripheral Europe for next year, something like Spain and Portugal, they're actually supposed to be growing above the EMU average growth rates of, I think it's 1.4%. They're supposed to be projected to grow about 2%. So actually, that's pretty solid when you compare it to, say, a France or a Germany.
But how much of that outperformance, yes, I fully understand that it is a function of a pivot towards services and structural changes that are helping the periphery, but it also feels like it's relative to weakness in the core in France and Germany. The minute, here's hoping, that France and Germany turn around and suddenly have a positive story, is that outperformance going to be as big or as noteworthy as it is right now?
Well, I think there's a lower probability, though, that the France and the Germanys are able to turn around and pivot and fix the structural issues that we're all alluding to anytime in the next sort of 12 months. I think that's a sort of slightly longer time frame. And so you still have at least sort of 2025 as a time frame where peripherals can continue to outperform core. At least that's what we think.
Let's wrap things up. The dollar. I come back to the comment about kind of, do we think that the Fed has peaked? Because there's this re-acceleration, or certainly the data are significantly better out of the United States right now. We saw it last week, and we continue to see it maybe this week as well. If the dollar re-accelerates from here to the upside, does that change the argument around EM credit? Where do I play that in terms of the EM credit story?
Yeah, I think there's a lot to be said about whether the Fed is at peak now, or whether there's a few more cuts before they have to do something again. And I think potentially tariffs coming in sort of...
Does the Fed have to change direction if tariffs come in? Say Trump wins, does the market price in a much more aggressive Fed?
I think if Trump wins, I think it is logical to assume that we will see upward inflationary pressure, and therefore the Fed potentially has to do more than they've done right now. Because right now all we've got is 50 bips in the bag, right? That's probably not enough of a headroom for them to fight what potentially is coming down the line. So we assume that between now and then, if the Fed does a few more cuts, they have more in the bag to play with. But assuming that they don't, I think you're looking at a sort of stronger dollar, as you said, the scenario of a stronger dollar. How do you play that in EM? Well, EM, there's winners and losers, and I think it depends on what you pick within your streams of EM. I think previously, when you were expecting a weaker dollar, it was very favorable to EMFX and rates, that sort of local rates. But I think when you're seeing a stronger dollar, if you see a scenario with a stronger dollar, I think what you want to do is you want to play within the corporate space where you're playing exporters, guys who benefit from having a stronger dollar and a weaker local currency, because when they translate that back into the local currency, it's much better. You're looking at commodity things.
Tunde, always nice to see you. Thank you for stopping by to see us. Tunde Lawal, joining us from Barings. This is Bloomberg. "30 minutes to the start of trading here in Europe, 30 minutes to the opening trade. It looks like we are going to have a fairly quiet start to the week. I guess Monday morning, things need to get going a little bit, but it is a busy week when it comes to the earnings story, Anna, and there's a lot to digest. There's a fair bit of corporate news, there's a fair bit of macro news. I wonder which of those two things the market is going to lean on the most heavily. Or does it turn out to be politics?
Yeah, I mean, we've got all of those things, haven't we, in the mix this week, so we'll certainly look ahead to those. In terms of the futures picture, kind of muted, really, for Europe, muted for the US as well, looking mixed in terms of those futures. Nasdaq futures down a touch, E-minis pretty flat. So that's the sort of equity market story. Over in the Asia session, we've had China outperforming because of some of the action, ongoing action by the PBOC in that market. Elsewhere, though, the Asia story looking a little bit weaker. In terms of bonds, then, we've just opened up around European bond markets, and we do see the yield in France going just a little bit higher than the, moving a little bit more than the others, I should say. 8 basis points there higher, but we are seeing it's in the same direction of travel as the other markets. And there's an ongoing focus. Guy, you were pointing to what we heard from Scope, the rating agency, and we're going to hear from Moody's at the end of the week. So an ongoing focus on the fiscal broadly, and in particular in France. Let's pick up on that fiscal conversation and fiscal challenges. The UK's Chancellor is reported to be planning real-term increases to the day-to-day budget of the National Health Service. The government is finalising next week's budget, with Rachel Reeves under pressure to give the NHS more financial support, despite tight fiscal constraints. For more, let's bring in Bloomberg's UK correspondent Lizzie Burden with details. Lizzie, good morning. Take us into this NHS story then, and this key promise then expected from the government, spending on the NHS in real terms, increasing that despite the fiscal constraints.
Well, the reason that this budget on Wednesday next week is such an important moment when it comes to NHS spending is this is the budget where she sets out spending for the next few years. This is really the moment if you're going to make changes that people can feel by the next election. If it requires pain to get there in the form of tax rises, do it now. So she needs to raise billions of pounds. This is a service, as we know, that eats money. But of course, it's a conversation that is needed because all of the pressures of the pandemic and an ageing population, Labour has promised 40,000 extra operations and appointments a week. But this is a time, as you say, when the government is incredibly fiscally constrained, and we keep hearing about that black hole in the public finances, now the £40 billion figure that Rachel Reeves says she needs to raise.
So what do we know about some of the plans to stem that gap?
Well, we have various measures reported, nothing confirmed by the Treasury yet, but raising taxes on entrepreneurs when they sell their businesses, reforming inheritance tax, the FT reporting potentially an extension of the freeze on income tax thresholds. That's interesting because they've promised...
That's the manifesto.
Exactly. They've promised not to raise taxes on working people. When Rachel Reeves was in opposition, she criticised...
Fiscal drag.
Yeah, stealth taxes. She criticised the Conservatives for this, saying that they were picking the pockets of working people, and yet now that she's in government, the potential £7 billion that they could raise a year seems to appear pretty tempting.
All right, Bloomberg's UK correspondent Lizzie Burden joining us around the set to give us a little bit of a preview of what to expect next week. We thank you so much. Let's go now to Germany, where the 4-day work week has been backed by most companies that took part in the trial. 3/4 of participants say they're not returning to the 5-day standard. Let's get more now with Bloomberg's Oliver Cook standing by with the guest.
Yeah, Kriti, thank you so much. Yeah, in Germany, we have this very large and growing labor shortage. And for most of the companies that participated in this trial run, what they did so was in order to become more attractive employers and try to bring more people into the workforce. What's interesting, though, is that the study also showed that despite a shorter week, revenue and profit remained stable, suggesting that productivity gains across the board. So I'm very glad to be to be joined now by Karsten Meyer, who's a managing director at Intrapreneur. We'll get there. Who conducted the study. So I'd like to just get on the sort of financial side of this. What did you learn about the 4-day work week and its impact on revenues and profits of these organizations?
Well, basically, to say that out front, we are the practice partner of the organizations or of the study, and there's been a scientific partner, which is the University of Münster, and they conducted this. It's super important because that's what it means that the data is correct and it's not like basically flawed by a consulting partner. And what they saw is that basically on one hand, the organizations have been able to significantly reduce their working time, around 10 to 15%, and then on the other hand, the revenue and the profit stays either stable or even increased a bit. And that what that means on productivity side is that the input went down, but the output stayed the same or went up, and that basically means that there's a productivity gain to reach here with the 4-day week.
Yeah, and so you say from the study, 73% of companies are going to keep this in place. What is the motivation for them? Is it the primary motivation that they want to be more attractive in order to bring employees? Is it their health? What is the kind of the main function for them?
I mean, it's all of them. Like, one is definitely attractive for new talents, but also retaining specific talents that they have already in their companies. And also top management said to both of them majority that this actually helped them and moved them forward. But then also they are very concerned about health and about also especially mental health of their organizations and making sure that their organizational partners, their talents actually stay in the organizations and are healthy where they are.
And then those that sort of rejected, some of them also left the study early. On what basis was that?
I mean, there are different ways. Like 10% now of those who, like 20% stopped now after the trial, and 10% of them actually said, okay, they want to go back to the 5-day week. No turning back, basically. And then in the beginning, after 2 months, we have 2 organizations who stopped taking part of the trial, and these 2 organizations were both larger organizations. Their reasons were mainly coordinated with the economic surroundings, basically economic challenges that they had in Germany at that time. But also this might indicate that for large organizations, a move to a 4-day week might be more challenging than to small ones or mid-sized ones. But It's just an indication. More data has to follow.
And what were your assumptions that you had going into this and the findings from the study? What surprised you the most? What was the greatest disconnect?
I mean, there are lots of things that surprised me, but one thing, basically, if you look at what organizations did to actually make the 4-day week happen, there are lots of things that we can talk about in a minute, but one thing that I loved is that they actually, over 90%, included their employees in creating new solutions to a better working world and more productivity. And I think this idea of like co-creating with the people in the organizations, that surprised me a lot that this worked.
And the other thing that I thought was interesting was that since people are working less, they had to make sort of more productive and better use of their time, which meant cutting out meetings and automating things that sort of forced it. Just break down a little bit what companies were doing. And also, what does this study tell us about how much useless things we're spending doing at work?
A lot. I think that's what we can say. Main thing is meetings, like you just said, like to reduce meetings or either structure meetings, make them more productive. That's half of organizations did that. Obviously working on processes, optimizing them, making them better. And 25% really doubled down on digitalization, which obviously in Germany, especially in mid-sized companies, is still a long way to go. So I'm really glad that this project somehow worked in that behalf.
And also, one of the big issues that Germany is struggling with is demographics and just not having the sort of number of people, also not having the productivity. This is, we're hearing also at the EU level from Mario Draghi's report, something really to boost. What would you like policymakers to take away from this study and the sort of the data that you've presented here in terms of sort of crafting their approach to solving these problems?
I mean, you have to say this is now a study focused on 45 companies, very small compared to the large mass of organizations that we have in Germany. But what you can say is that this approach to a 4-day week helps specific industries and maybe specific companies to actually get ahead. And for example, we had 2 kindergartens, so social organizations in our pilot that actually helped us or observed that a lot of people are now coming into this market and want to work in that context that maybe before didn't even consider going into social work or going into care work. And so maybe that can be an opportunity, especially for markets that are struggling and that we really need in Germany to move forward to get new talent into the areas.
So the idea being that even though people are working less, there are actually a greater volume of participation of people joining into the workforce. Yeah, you also took, and I thought this was interesting, took hair samples, you had sort of health trackers for people. Yeah. What did you learn from that in terms of levels of stress?
Well, hair samples are still to be confirmed and defined what this means. Yeah. But from the trackers, which was really interesting, we for the first time got objective data in a 4-day work study worldwide around stress and health and sports. And usually what people in other organizations, also in the UK, observed is that stress is going down. And we were asking, can that be possible with more work in less time, basically more pace? Can this be possible? And the trackers show that this is actually true. So if you work a 4-day week, your weekend, basically, your stress goes down really a lot to a Sunday where you really are at your lowest low of stress, whereas the 5-day week actually gains stress at the same time. So that's really interesting.
And just a final question, because Germany isn't the only place that this study has been conducted. What were the differences that you saw between what you learned from these sort of employees in companies in Germany versus the ones in the UK and New Zealand, for example?
I mean, in general, we see the same effects or similar effects. I think we've done a lot of more work in doing control groups and more scientific objective things to figure out like what works and what doesn't. And what we didn't see is a decrease in sick days. And so we're asking ourselves, why are we seeing a decrease in stress and health, but not so much in sick days? At the moment, our interpretation is this might need more time so that we can actually see it, but that's a main difference.
All right, well, Carsten Meyer, thank you so much for your time today, the Managing Director at Intra intrapreneur and looking at the study of the 4-day work week. I should also end, we were talking about the sick days here, this sort of another piece of sort of interesting data, guys, that the average German worker takes 21 sick days every year.
Thank you, Ollie. Oliver Crick with the news you need this morning, and a really interesting conversation there about the 5-day week and whether it should drop. If you're not feeling so great this Monday morning, maybe you like that conversation, or maybe it's not what you wanted to hear. I mean, maybe it's all very sector and role specific, whether this is going to work in people's individual jobs. I was really taken by an editor's letter we had over the weekend, actually, talking about the weekend, because we had a new product launch here at Bloomberg around the weekend. And it actually reminded me that the modern weekend, yes, it's a bit older in England, and it goes back to the end of the Industrial Revolution. But in the US, it's only about 100 years old. And Henry Ford in 1926 introduced it in his factory, and that was one of the key things. He wanted people to go out and spend more money on cars, though. That was part of the driver.
Absolutely. The study does seem to indicate, though, that you can be as productive in 4 days as you can be in 5, which makes you wonder, are there productivity benefits? How do you... The next step to this has got to be to figure out how you get the same productivity benefits that you're getting from the 4 days, but in 5 days.
That just sounds like working harder.
It does, yeah. But
missing the spirit of the effort. And does that
maybe, but I suspect if you're a company looking at this going, yeah, we're getting great productivity out of our people in 4 days a week, and then suddenly the economy takes off again, or can I get a competitive advantage by delivering that same productivity in 5 days a week? How do I... Are there good things I can take away from the 4 days but apply them to 5 days? So it's going to be interesting to see how the next step of this goes. As a person that works 5 days a week, though, I'm firmly in favour of the 4 day a week.
It's fair. But to your point of productivity, there's also firms that have unlimited time off, for example, and then they actually found that people take much less because of the pressure and because of the kind of almost stigma around taking time off.
Yes, they're the geography and the industries very specific, aren't they? And they probably make a lot of assumptions about the level of ambition amongst their staff, and therefore the impact it might have.
Coming back to the German thing, 21 days a year sick days is quite interesting, though, in terms of what that means in terms of national productivity. It takes you back to the kind of migration story. Germany feels like it needs more skilled workers. It has the workers. Maybe those workers aren't just fit and healthy to be able to do the job.
And that comes back to the NHS
argument as well, about migration, how the economy is performing, how productive the economy can be in totality, and whether or not this is getting more people to go back to work rather than worrying as much about the 4 day week and things like that. This is maybe where the genesis of the story should start.
Let's talk about someone who definitely does not work 4 days a week, arguably more than even 5, and that is Christine Lagarde. We have an exclusive interview with the ECB president there at 3 p.m. UK time tomorrow. I imagine this conversation around productivity is going to be certainly one that comes up in terms of the labor conversation and maybe how that shows up in some of the data as well. So again, 3 p.m. UK time tomorrow, exclusive on Bloomberg TV. Coming up on this program, however, CD&R takes another step towards purchasing Sanofi's Apelli unit. We're going to bring you the details alongside your other stocks to watch next. Stick with us. This is Bloomberg.
I'm not in a rush to get to neutral. We must get inflation back to our 2% target. And I don't want us to get to a place where inflation stalls out because we haven't been restrictive for long enough. So I'm going to be patient.
Being patient, Federal Reserve Bank of Atlanta President Raphael Bostic speaking on Friday at the Mississippi Council on Economic Education. So he's being patient. We've seen the PBOC, though, taking action on rates, cutting rates, trying to stimulate what's happening in the Chinese economy. Let's bring in Paul Dobson, Bloomberg's executive editor for Asia Markets, who joins us now to talk about the markets in 3 minutes. And Paul, thinking about what the Chinese are doing, I know not everybody convinced that the whole suite of policy measures is going to be enough to turn things around in China. Maybe some of the geopolitics gets in the way. I know the Aramco CEO is quite positive, though. What did you make of all that?
Yeah, so interesting comments from the Aramco managers talking about the prospects for China's economy coming back and the opportunity for there to be getting more involved there. I think what's really interesting is you can think about this in two kind of ways. One, it's a positive comment on the economy. Also, and in the context of the BRICS meetings coming up this week, it's a comment on the sort of relationship that's being built between Saudi Arabia and China. China's really doing everything it can, I think, to build this relationship, to cozy up a little bit more to the Gulf nations, the Middle East nations, the Global South, the BRICS nations in general. And it's reciprocal as well. You know, we've seen meetings this year between Saudis and China and deals done both ways as well. Flows of cash. We've seen ETFs set up to allow for stock investments as well. So I think that you can see it not only as a positive endorsement of the economy, but also in the context of these meetings coming up, more confidence in that relationship, which is sort of diversifying a little bit away from the US and away from the US dollar as well.
Hold your nose by the Mag 7. Carson Block talking to Haslinder a little bit earlier on. He's definitely not convinced about the longevity of the China trade, Paul.
No, absolutely. And if you look at markets today, you know, it's a little bit wishy-washy again. You know, what we have seen is some diversification between onshore and offshore markets. Onshore behaving better because we have this buybacks news coming through. So a lot of companies announcing buybacks today and getting some funding for that. On the other hand, you know, Hong Kong really not performing particularly strongly. We just need that continuing confidence of more and more stimulus announcements to come through in order to prop up the market. And there's still a lot of international investors that would prefer to stay away.
Paul, in our last minute here, talk to us about what's going on in gold. We kind of rack our brains in terms of what's driving that move. What is it in your view?
Yeah, well, I think one thing that's really interesting is you can tie it back to this big BRICS conversation. In some ways, there's a lot of emerging market nations that seem to be stockpiling gold, building it up in their strategic reserves. And so people are looking for those kind of diversification plays away from you know, the US dollar, away from traditional currencies in general. We're also seeing Bitcoin perform well for similar sorts of reasons. And so I think that that is also playing into it. People have been talking a lot about deficits and debt loads and that kind of thing, particularly over this weekend. There's that mistrust in the financial system in general. So that's one thing, I think, which is adding to the sort of demand for precious metals and alternatives to currency at the moment. On the top of that, you've got the election risk, you've got plenty of Middle East risk as well, so other reasons for people to want to buy it, and more practical things like Indian buying for jewelry and such like. So plenty of reasons to like those precious metals at the moment.
All right, Paul Dobson, Bloomberg's executive editor for Asia Markets, joining us for the markets in just 3 minutes. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Kriti. So Kering is losing one of its long-term buy ratings today as Citi downgrades the stock, having been buy on the shares since 2008. Now Citi today writing that the execution of luxury brand turnarounds has become more complex due to consumers preferring the more stable brands, the likes of LVMH and also Hermes as well. Now, as we can see from this screen, Kering now only has 3 buys among 33 analysts rating the stock. It has been a big underperformer in the sector, giving the slow turnaround over at Gucci, actually underperforming the broader luxury sector by around 45%. So a lot of those analysts giving up on those buy ratings now. Then in terms of M&A, Sanofi is in the headlines again. We are getting some progress on the potential sale of their consumer health business, Pella. They're announcing they are in exclusive talks with CD&R for a 50% stake sale. That would be a controlling stake. Pella valued at 16 billion euros in terms of the enterprise value. And importantly, Sanofi also upgrading its business EPS guidance this morning. We can see from the Sanofi chart that we have actually seen a rebound in that stock, given a massive slump last year when they warned they'd have to spend more money on research. But talks on this deal have helped the stock to recover from those levels. So keep an eye on that one over in Paris today. Then in terms of banking, a bit of M&A there as well. DNB over in Norway is doing a deal to buy Carnegie. This is an investment bank and also an asset manager. Has around 850 employees, and the deal's worth around $1 billion, so it's a decent size. The Nordic banks actually have outperformed a little bit recently, given their stronger net interest income, so definitely an interesting bit of M&A in that space this morning as well. Then in terms of your ratings changes, a couple of upgrades. Firstly, in the UK, Barrett Redrow in the home builder space, that's an overweight at MS. Nokia comes up to Danske Bank. That stock had a big surge last week following their earnings. And finally, going the other way, we've got a couple of downgrades in the Spanish banks from Barclays. One of them is CaixaBank, the other is Bankinter. Both of those could potentially be weak this morning.
Joe, thank you. Our equities reporter Joe Easton with that Monday morning briefing. Another couple of stocks that could be in focus. I'll mention JDE Peet's, the coffee retailer, because it seems appropriate at 7.53 here in London. A stake in that business changing hands, a Mondelez stake going elsewhere, and it seems it's changing hands at a price that's quite a bit higher than where the stock closed on Friday. So we'll see what that does. It also might increase the free float as well.
We'll watch that one. There are plenty of upgrades and downgrades today. I think the chip sector is going to be really interesting this week. You've got the kind of the fallout from the ASML story last week, which is going to be interesting. We are going to hear from NVIDIA this week. You've got Texas Instruments going to be reporting numbers too. And you've also got kind of a series of stories out of Europe this morning. Infineon, that's a much more car-related story. So I think this week it's going to be really clear kind of what is going on in the chip space, the winners and the losers. And it's really interesting to see the gap, the wide gap that's beginning to emerge even within that space at the moment.
You're talking about the chip space. I'll broaden it out to the other applications of the chip space. Tesla, of course, coming this week as well. So we'll talk about the EV trade as there. But then also SAP after the European close today. And I think that one's going to be a good precursor for what we get in the States next week when it comes to Alphabet and Microsoft revenue.
Yeah, our colleague Dan Curtis pointing out that markets are not expecting as much volatility around the Tesla earnings as we normally get. I wonder if that's because we got quite recently that update on robo-taxi, didn't we? And so whether any high expectations have already been dashed on that particular front. And so maybe that factors in to the earnings story there.
Lots to watch. Is the macro story going to play a picture? Are we going to continue to watch the data? Are we going to change our minds when it comes to what is happening with the ECB? Lagarde speaks a lot this week. You've also got a fair bit of US data coming out as well. Got interesting data out of Germany. Where is the emphasis going to be this week as we count our way down towards the US election? 15 days away, I think, is the number I heard Tom McKenzie talking about a little bit earlier. Anyway, the opening trade is coming up next. This is what futures are signalling right now. We'll bring you the actual open in just a moment. This is Bloomberg. Monday morning, good morning. Let's talk about the Friday legacy and how that's going to be factored into the opening trade this morning. There's not much of a legacy, actually, to be brutally honest. As you can see, the white line, Europe, going out pretty much where the US closed as well. We saw a couple of attempts to push higher in the US session. That faded a little bit. But US stocks are trading at fairly punchy levels right now. But nevertheless, in terms of the exact futures read across, I'm not sure there really is one coming out of this story. There's another few factors that we're worth bearing in mind, Kriti. But basically, a fairly flattish open being priced right now.
Yeah, it kind of feels that way, except for when you look at France. And that's where you aren't seeing anything punchy at all in terms of a positive read-through. Brutal, almost all 0.5% declines in the French futures. Some of that might be a function of the downgrade that we got over at Scope. Is the read through into those French banks? We're going to keep an eye on that. But you can see how it's showing up more in those Euro Stoxx 50 futures, and down 0.3%. The FTSE 100, as Guy pointed out, completely flat.
Yes, absolutely. So when it comes to France, Kriti, we'll keep an eye on the banks. We'll also watch Kering, because as Joe was telling us, we've seen a downgrade to Kering. And bear in mind that actually luxury players did pretty well on Friday. Kering was up by more than 3% during Friday's session. And today, Kering has lost its long-standing buy over at Citi. Only 3 remaining buys on that stock. So that's one that's going to be in focus. Sanofi also in focus, talking of all things French. But that's really about a deal that gets them closer to offloading 50% of their Appella consumer health business. They've actually upgraded their guidance on the back of that. We'll also keep an eye on DNB. This is a business that is buying Carnegie Holdings. So there could be some movement over on that particular stock. We'll watch that one, Guy.
We will. Watch all of that very, very closely. So it's time for the opening trade. Let's see how Europe is opening up this week. Got an awful lot of earnings to think about this week, so we'll be working our way through that over the next few days. But this morning, the story looks like this. The opening trade is basically a flat one, certainly for the FTSE 100. Barely budging at the get-go this morning, in and out of positive and negative territory. Can't quite make up its mind. Let's talk about some of the other markets as they start to get going. France is going to be the most interesting trade, I think, this morning at an index level. We are expecting some negativity. We've got the Kering story to factor in, but you've also got the Scope downgrade as well on the ratings front. Does that ripple through into the French banks narrative? Remember, we've got more ratings to work our way through towards the end of this week. Are we going to see some more turbulence there? So the CAC 40, as suggested, down by a little bit more than most this morning. We're down by nearly 0.5%. The IBEX is down by 0.3%. We'll wait for Germany to get going. In the meantime, Kriti, what else is going on?
Well, as expected, you are seeing the biggest weights on the stock 600. They are all really French companies. And I think a regional story is more kind of clarifying into this morning's trade than perhaps a sector one. In that Schneider Electric, for example, is trading right alongside Sanofi, right alongside even BNP. A lot of the French names, Anna, really weighing. And this feels more of a regional story.
Yeah, so as Guy's been pointing out, we saw that scope downgrade. We're also moving towards some possible action by Moody's on France on Friday. So that keeps that narrative in play through the week. We will see whether they decide to do anything with that rating. And every day, day after day, we're watching to see how that government performs and how long it can last. In terms of other sector highlights, we see energy stocks doing OK this morning. There aren't many sectors in positive territory, are there? But energy is one of them, up by 0.4%. The oil price is a little stronger this morning. Middle East tensions in focus. Also Chinese demand, I suppose. Ongoing focus on that. Retail, basic resources, both of those sectors in positive as well.
The CAC 40's only got four stocks now in positive territory. The heavyweights, Schneider, LVMH, Air Liquide, Sanofi, AXA, Vinci, Airbus and BNP Paribas. It's interesting to see some of these really big French names under significant pressure. Why is that? Is the Kering downgrade rippling through into LVMH this morning? Maybe a little bit.
Yeah.
Are we seeing something on the French banks? Maybe. BNP's down by 0.5% this morning. It's interesting that actually Stellantis is adding the most points on the upside in the French market this morning, as is Renault. So both of the French car names, after being battered last week, are seeing maybe a little bit of rotation that is taking them positive this morning.
I was going to point out the banks as well. You mentioned BNP there. UBS taking a little bit of a beating. HSBC is down as well. And I'm curious what the bank read-through is here. I'm not seeing a ton of rates action, but perhaps that's the broader spillover from the French bank story into the broader one?
It can be. And the banking sector didn't do too badly during Friday's session as well. So a bit of pullback on that one this morning.
We've got Barclays out this week, haven't we? We've got NatWest this week. I think we've got Lloyds this week. So there's a bunch of European banks that are going to be worth focusing on. Europe still trades, though, at a pretty epic discount to the United States, as do most markets around the world. So what do you do with that? Well, Muddy Waters Capital founder Carlson Bock was talking to Bloomberg a little bit earlier on. He says you just got to hold your nose. US stocks are still a safer bet than the Chinese markets.
There's a Fed put. There's always a Fed put. You know, does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much. Just close your eyes and buy. Probably Mag 7.
Got to close your eyes, though. Does that make it an investment or a bet? Christian Mueller-Glissman, head of asset allocation research at Goldman Sachs, sitting around the table with us this morning. Good morning.
Morning.
The discounts that Europe has to the United States is epic. The discount that Asia has to the United States is epic. Yet, you've got seasoned investors saying, you just got to keep going. You just got to close your eyes, hold your nose, whatever it is, and invest in the United States. Is that still the right way to go?
You know, I think we also overweight the U.S. into the elections. I think tactically, but also looking a bit beyond, the U.S. is still in a much better spot, both economically, from a policy point of view, and I think even from a corporate profitability point of view. I think one of the most important things to always keep in mind is the ROE, the corporate profitability of the U.S. is just so much higher. And that explains a large amount of that valuation premium that it has. So if you want to be bearish on the U.S., it probably requires the view that ROEs will come down, which is possibly a longer-term process.
What though, keeps the train kind of on the track? What keeps the U.S. market moving high? Is it rate cuts? Because people are calling those into question now, given the strength of the U.S. data. Or is it you can just have your cake and eat it? If the economy is strong enough, that's great, because the earnings story is going to be fantastic. If the economy is weak, well, the Fed puts there. You've got it both ways, don't you, with the US markets?
Yeah, I think right now the important thing is to essentially recognize that we're in a different regime to the last 18 months. In the last 18 months, you had what we call the inverse Goldilocks scenario, where inflation came down and growth was actually remaining strong. So normally Goldilocks means growth goes up without inflation. Yep. This time the reverse. And it means it's incredibly carry-friendly, it's incredibly vol-anchoring, and it's good for the S&P 500 because the S&P 500, the Mag 7 in particular, they're like a carry trade. They have like recurring income, and these type of environments are very good for carry trades. They're boosting their valuations. But now we're shifting into more of a reflationary backdrop in the US. So you're essentially seeing growth take over.
So reflationary,
yeah.
Not deflationary. Okay.
No,
Yep.
not deflationary, reflationary. So you see growth take over, which means you don't have bond yields go down at the same time as growth is good. So that starts to be a bit of a bumpier backdrop for U.S. equities. But I would still say that, especially with some of the positives that could come off the U.S. elections, which could be negative for the rest of the world, and coupled with the fact that you currently see Europe on the corporate profitability side do really poorly as well. And China has a lot of uncertainties. So I can understand why people prefer the U.S.
One of the bear cases for Europe is that the last couple of years have been largely expected to be late cycle in terms of the expansionary cycle, basically, for lack of a better term. What does that reflationary narrative do to the bull/bear case for Europe?
Yeah, I mean, the good news about Europe is it's not late cycle at all. So if you're worried about overheating ever again, I think Europe won't overheat. You see proper disinflationary momentum. That's great. I think we know disinflation is to some extent good for bonds and can be good for equities if growth is good. We saw that with the US. The problem is in Europe, the growth isn't good. We've just downgraded in this earnings season our top-down earnings growth forecast for this year to kind of 2%. So we were at 6% before. So you can really see that the challenge you have is that Europe has certain sector exposures, certain kind of macro exposures that are really hitting the profit side. So the disinflation is positive for bonds, but it's not good for equities.
So what does it take for you to say, from an entire regional perspective, to buy the index? What do you need to see?
I think, as we know, everything goes in cycles. So if you kind of decelerate right now, if you have like a kind of negative cycle impact, eventually you will have a turn. And we've been hoping for that for some time. You have like savings rates in Europe running at 15%. You have the global manufacturing sector being in like an 18, 19-month contraction. So the hope is that if you had lower rates, you start to see that type of trapped liquidity, that type of deleveraging, destocking cycle start to turn. But the problem always, and we've seen this before, is it's not just lower rates that are required, it's confidence. And the challenge you have in Europe and to some extent in China as well is that there's been a lack of confidence because of longer-term issues coming back on the table. You mentioned the fiscal issues in Europe. In China, obviously, there are plenty long-term issues. And that's often where policy comes back to the table and tries to generate confidence. And China already had a bit of an attempt at that. The problem is in Europe, the policy picture still seems very kind of like constrained and more focused on consolidating fiscally and not necessarily stimulating.
I'll come back to the fiscal side in just a moment, Christian. I just want to talk about the election, put that firmly front and centre and think about the US election and what that means for stocks. Looking back at the last couple of elections, it almost feels as if stocks post the actual event find a reason to rally. So but it can be completely different and contrasting reasons. Yeah. So in 2016, rallying on the expectation of lower taxes, lower regulation. 2020, rallying on hopes of more fiscal spend. These things are sort of opposed, but they can both be good for stocks. In thinking about that and the sort of day after the election and the months afterwards, what are you expecting to see?
I mean, first of all, the big problem you have is that everybody knows that issue, and I think it feels like this time around the market has pulled forward some of the relief. I think a lot of people were going a bit cautious into the election, and it seems people have been squeezed in a bit. I think generally the pattern you see is that the VIX, the kind of volatility index, picks up in the 3 to 4 weeks before. That is especially true if you include the whole sample, but there's some recessions in there. So if you take the recessions out, it picks up usually. It picks up more if there's a prospect of a unified government because that increases policy uncertainty. And then if you get the elections getting closer a week before or after, you start to see a volatility normalization. That volatility normalization tends to be larger if you have a divided government because it caps the policy uncertainty.
So one thing we certainly watch then in terms of volatility is, whether we have one party in full control or whether that control is divided. What about on the fiscal side? I imagine that has an impact too on fiscal freedoms in the United States. And the IMF out with a warning today talking about global debt, public debt, rising to $100 trillion a year and thinking that this is something that needs addressing. Do you see any sign that we see fiscal pullback in the US under either administration?
I think as of now, our economists don't expect that under either administration. And I think the important thing to keep in mind is when you think about solvency, in a more philosophical way, but also for governments, is you've got to ask yourself, do you think that country will be able to pay back their debt? And I think most countries globally currently have high debt-GDP ratios. The US is a very productive, asset-rich economy. So to some extent, you're kind of having the least pressure on the government to fiscally consolidate because they still have the best long-run outlook. So I think that might change. But at this point, we don't really expect the market pressure or the general pressure on the US government to consolidate fiscally to increase.
I'm going to circle right back to the volatility trade that you were talking about, that typically there is this increase going into the election. You're seeing the exact opposite right now, and that it actually feels like there's a decrease. Why is that?
I think it's the market to some extent pulling that forward. If you look at the election odds in the last 2 weeks, they've really shifted aggressively in the direction of Trump winning. And I think the odds are now 92, 93%. So the market is pre-trading that. And it's to some extent dangerous because we know these odds are not perfect. They can be distorted. But I think the market certainly seems to want to pull forward the kind of the election outcome already and fade the uncertainty.
How will the Fed react if Trump wins? And how will the market react if the Fed does react? Will the market force the Fed maybe to take a more circumspect view in terms of cutting rates after a Trump win? And what would that mean for equities?
I think we're already having a bit of a reflationary shift that started with oil and higher oil prices pushing up bond yields, and now it's shifted a bit more in this direction of potentially Trump winning and being more reflationary. For equities, that doesn't have to be the end of the world. If bond yields go up because of better growth expectations, the market can deal with that as long as it's not too fast.
Better growth expectations or higher inflation expectations?
If it's higher inflation expectations, then there's a trouble. But I think the important thing to keep in mind is there is not necessarily a direct inflationary impact from some of Trump's policies. Like, you have to consider that services sector inflation is very hot in the US, not goods inflation. So even if you do get tariffs, which might be a one-off price level shock, they might not even linger. And the Fed has already said they might look through some of those price level shocks. I think if you have a goods inflation pickup, you're coming from a very low base. You're dealing with a disinflationary global goods cycle. So that is a bit less scary. What is scary, however, is if you are easing financial conditions via boosting the equity market a lot, and that kind of makes the consumer spend more. We know that there's a huge kind of household allocation to equities in the US. So there's a wealth to income ratio effect. So if you boost the equity market higher and higher, the savings rate might even drop more because people feel wealthier. So I think that is to some extent a concern. And I think the market already has taken out, it seems, a lot of that risk management that has dominated the post-summer kind of Fed repricing. I think the market has already priced the front end a bit.
Great to see you. Thanks for stopping by to see us.
Thank you.
Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Little bit of a redhead crossing the screen. I just want to flag this before we get to the core six. Moldova approving the referendum on joining the EU by a super slim margin.
Yes, it seems they've been busy counting. They've counted 98% of the votes now, and the margin is extremely thin. Moldovans vote 50.16% in favour of EU referendums. These things often seeming to be close. And there's the result there. There were two things they were voting on Sunday in Moldova. One was their presidential election, and they seem to have backed somebody who was more pro-EU. And so that very slim approval of joining the EU would seem to fit with that broader picture.
Well, the context is also really important here in that this is a country that is very aggressively shifting where it gets a lot of its exports from and its consumer demand away from Russia towards the EU, and this is part of that decision.
And that's a very tight journey, difficult journey. OK, core six looks like this morning in terms of what we're seeing around Europe. We are seeing some weakness in French stocks this morning, and you can see that writ large here. LVMH softer, not as much as it was. Schneider down 0.7%. Elsewhere, some strength. Let's see what other single stocks we're watching. Joe, over to you.
So JDE Peets is the best performing stock in Europe today, up 13% over in Amsterdam. This is on breaking news that JAB, the investment firm, is going to buy a big stake in the Kenco coffee maker from Mondelez, the Cadbury's owner in the US. It's one of their biggest shareholders. Now, the important thing here is that the price on the stake purchase is massively above where that stock closed yesterday, hence that big gain. JDE Peets also announcing a change in CEO, but it really seems to be this change in the shareholding that is driving that stock higher today. Then another stock moving higher in the auto space is Forvia, up 8.8% at the moment. This is the car parts maker. Had a couple of profit warnings out of that sector recently. They've given guidance today. They are saying that they're still seeing weakness in China and also the EV slowdown, but the fact they haven't actually downgraded their profit forecast is actually seeing a bit of a relief in that one today, and also lifting the big rival Valeo as well. Both of those over in France seeing decent moves higher following that statement from Forvia. Then in terms of your UK home builders, a bit of a move higher. We did actually see Rightmove data overnight showing that there was a smaller than expected rise in UK house prices in the past month. Now, some are saying that's because of the budget coming up, but probably more about the mortgage rate still being too high to get people really buying in that market. This one down the bottom here, outperforming at Barratt Redrow. They have got a new overweight rating at Morgan Stanley today, which says that is the best way to trade the housing recovery when rates do come down. So that one is getting a bigger boost this morning. Then your other ratings. Now we have got Infineon, this one cut at Morgan Stanley. Now this is also actually tied to the auto sector. They say that Infineon is suffering from lower demand for chips used in the making of EVs. So that one coming down there, falling 2.0% at the moment on that one. Then in terms of insurance, Munich Re gets a downgrade. This is, as Jeffrey says, the company could face as much as 1.2 billion euros worth of claims related to Hurricane Milton that hit Florida a few weeks ago. And then finally, the one we mentioned earlier, Kering, is downgraded at Citi after 16 years at buy. Finally, Citi giving up on the buy rating on Kering, and that one slipping another 0.5%, down around 45% this year for the Gucci owner.
Joe, thank you. Joe Easton with your equities roundup. Coming up, a big week for Boeing. Striking workers are to vote on a pay deal on the same day that the struggling plane maker releases its results. We'll bring you the latest next. This is Bloomberg.
Welcome back. Bit of corporate news out of France. Sanofi and CD&R making jobs commitments for France, saying that jobs will remain in the country, talking about an investment of 70 million euros in France over 5 years. I think the French government is having a press conference as well, just to lay out some of the details around this deal that has been done. Airbus is a company that's going to be reporting next week. This is my link to Boeing via France. But Boeing is going to be the story this week. So over the weekend, we get a deal that is done. It looks like the White House probably had some influence on this between the union and Boeing's management. 35% is the deal that is getting done in terms of the wage increase that we're talking about here. That's over 4 years. Is that going to be enough to tempt the 33,000 striking workers back onto the line? Or are issues like pensions still a significant enough issue to maybe get them to vote against the deal? Now, the vote is Wednesday, which is the same day as the company is going to be reporting results, which means that basically the results aren't going to be the main event of the day. Benedict Camel, our global editorial leader in aviation, joins us now. Benny, good morning. The deal is significant. The wage increase is significant. The problem with it is that it doesn't maybe address the issue around the pension demands that striking workers are pushing for.
Yeah, you're right. The pensions were always sort of the sticking point, and it's something that the workers wanted dearly after they lost it in a very contentious round more than a decade ago. Boeing has always said, this is a red line for us. We're not going to reinstate the old pension plan. And it looks like that's still sort of their line. The latest proposal, as we laid out, 35%. To give people a sense, we came from 25. That was the original offer in September. Then we went up to 30, and now here we are at 35. There's also a couple of other sweeteners in there. There's a signing bonus. There are a couple of other improvements. So all in all, it looks like the Boeing side has moved a fair bit. Whether it's enough to get it over the line is unclear. If you take a very unscientific view of what's going on in the online forums, it looks like a lot of people are saying, let's get this done, let's vote in favour. They need 50% plus one to get this over the line. So this is probably as good as a chance as they'll have, but you never know.
Yes, and take us through what might happen here then, Benny, next. I mean, you've laid out how this is all very uncertain, but the workers who vote on this on the day that the earnings come out, incidentally, as Guy was saying, they have a history of not being convinced by even their own union leaders. So I suppose that's an extra unknown factor.
Yeah, you're absolutely right. So let's not get too carried away and too optimistic here, because just about a month ago, just a little over a month, both the union and the Boeing side came out with their first proposal that was backed by both sides. And they both said, look, this is as good as it gets. Let's not forget that Boeing's in a very difficult financial position. Let's vote in favour. And then the workers turn around and slam that offer and really almost unanimously turn it down. And here we are, week 5, heading into week 6 of the strike, costing Boeing dearly every day. So we're at a point where probably both sides are somewhat weary. Boeing certainly is, but the workers might also start thinking about, is it going to get considerably better, or might we just take what we have and run with it? And it might look that's the way it's going to go. On Wednesday, as you said, we have the earnings first. Those come midday over here in Europe, very early in the US morning. And then the workers vote, and the result of that won't be known until late in the day. So in some ways, Kelly Ortberg, the CEO, will be presenting these numbers with a big unknown hanging over him, because if indeed he gets the strike resolved, that'll be a big boost for him. But if he doesn't, it's back to the drawing board.
And that, of course, will have an overhang on the equity picture as well. Benny, I'm curious, when we wake up Thursday morning and see how the vote happened, what the read-through into the credit is going to look like.
So the credit rating is obviously one thing that's very closely watched. The company is one step above junk with the main rating agencies. They have said that the strike and the duration of the strike plays a major role in how they see the company. Boeing did last week manage to sort of put the first contours of a new financing package out there. They want to raise as much as $25 billion, potentially in stock and debt over the next 3 years. So they've given themselves a little bit of breathing space, but at the same time, were the strike to drag out, it would make it increasingly difficult for them to hold on to their credit rating. So really, all eyes are on this Wednesday, and the optimism is out there. The sort of general mood is let's get a deal done. The White House got involved over the weekend and late last week, so there's that extra element of pressure from the political side. So all the stars are kind of aligned, but you could say that's what we thought last time, and workers voted it down. So let's not get too carried away.
I mean, a 35% wage increase over the next 4 years, one of the biggest asks that you've seen in a lot of the labor movements across the United States. Bloomberg's Benedict Campbell, we thank you so much for putting that into context for us. Coming up, we're going to talk about another company, another man who's no stranger to that labor conversation as well. Elon Musk's promise of a daily $1 million giveaway prompts a call for an investigation. This, of course, in light of the U.S. election, which is just 15 days away. We're going to have the latest on the campaigning ahead of the U.S. presidential race next. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session. Interesting on the surface, seeing an unchanged movement on the stock 600, but you are seeing red in the rest of the market. Remember, we did open the market with quite a beating in the French stocks. Looks like some of those losses have been paired. Let's go to another top story we're keeping an eye on. Wall Street is betting big against the clean energy transition. A Bloomberg analysis of more than 500 hedge funds reveals they are net short batteries, solar, electric vehicles, and hydrogen, while going net long on thermal coal. Bloomberg's Tasneem Brager joins us with the story. It is, of course, our big take. Tasneem, a pleasure to have you on the program. Can you walk out, or lay out, I should say, your reporting? Walk us through why it's significant.
Yeah, good morning. So what the reporting shows us is that despite all the stimulus, so the more than 2 years of the Inflation Reduction Act in the US, which is just essentially a piece of legislation that provides tax incentives specifically for green investments, and despite the enormous legislative and regulatory framework that supports the green transition in the EU, hedge funds, so investors who care only about profits, as a group, appear to be largely betting against key green sectors. So, as you mentioned, specifically, our analysis found that more hedge funds are net short solar than are net long. More hedge funds are net short electric vehicles, hydrogen, and batteries. And that is more shorts now than we saw, for example, in 2021. At the same time, there are more hedge funds that are net long oil, gas, and even coal, which, as you know, is the most polluting fossil fuel out there. So despite the historic stimulus packages, there's just limited appetite to invest in an investor class that focuses solely on profits.
Is this about the green story itself, or is it about the fact that actually the market got ahead of itself in pricing around the strategy, and that is why we are seeing maybe these hedge funds backing off a little bit, or is it a lack of belief in the whole process itself?
It's a good question, and it's a good framing of the question. It's probably a combination of all of the above. So there was a lot of enthusiasm around the green transition, COP21 in Glasgow, and during the pandemic, when economies ground to a halt, there were emergency interest rate cuts. There was very little demand for energy, for fossil fuels. In that environment, suddenly, there was this surge in green ESG funds and ESG and sustainable investing in general. That obviously changed dramatically at the end of the pandemic when lockdowns were wound back and the economy came roaring back. Interest rates rose again. Then there was an energy crisis, which was obviously exacerbated by the war in Ukraine. Now, the situation now is that there's been this expectation since the beginning of this year that with interest rates coming down again, the green sector would bounce back, especially with all the stimulus that I just mentioned. There are a few pockets that are doing better, like wind, for example, and hedge funds are generally sort of positive grid infrastructure. But the big story now, when we speak to hedge fund managers, is the geopolitics of it all. That's simply getting in the way of having a sort of a secure bet. So the tariff wars that we see with Europe and the US in particular imposing tariffs on China and China then retaliating, the outcome of the US election is obviously going to be key in determining how all of that plays out. So we've had hedge fund managers talking to us about explicit geopolitical risks as, a key reason why the energy transition as a theme, quote, isn't working out. We had another hedge fund manager telling us that, wherever you see China, run for the hills as an investor. So that's obviously particularly true for solar. So we've got a situation where a global challenge, namely climate change, is being sort of very much, is colliding with nationalist, even protectionist, if you like, interests.
Yeah, and Tasneem, then taking a step back, where does that leave us? Because you've set out there some of the cyclical and structural drivers that took us into ESG, and then sort of we got investor whiplash from some of that, perhaps post-pandemic. What are the big takeaways then from this reporting?
Yeah, I mean, as I said, one of the big takeaways is that we've got a global challenge and a very sort of nationalist, protectionist sort of response to it at the moment. So the response seems to be, first of all, we have to wait and see what the outcome of the US election is, because obviously there is a likelihood that Trump will be raising tariffs more than a Democrat administration would. And we've also got to see, how the whole sort of price effect of extremely sort of competitive pricing coming from China affects industries in the US and Europe, and how they sort of manage to deal with the competition issues, much of which was also sort of addressed in the Draghi report. But yeah, geopolitics is a key hurdle, and that is actually one of the reasons why grid infrastructure, for example, which is seen as an area that is protected from protectionism, which is why that's somewhere where hedge funds actually are putting their money.
Tasneem, thank you. Bloomberg's Tasneem Brogger bringing us that big take story. You can find that full big take story, of course, on the Bloomberg terminal and on the Bloomberg website. A lot more detail in there. She was mentioning the risks around the US election and what we're monitoring. So let's bring in the latest on the US election now. Elon Musk says his super PAC, so his political action group, of course, will give away $1 million daily until election day to a signatory of a petition calling for free speech and the right to bear arms. The world's richest person has been campaigning for Donald Trump in Pennsylvania. Let's speak now to Bloomberg's Derek Warbank now. I mean, it's no secret his level of support for Trump. He's been very vocal in his support for Trump for quite a while. It seems, though, that this giveaway by Musk, Derek, is quite controversial.
Yes, it is. And thank you for having me. Look, Elon Musk is, in no uncertain terms, Donald Trump's most prominent surrogate, right? He is the voice of the aspirations of a great number of Donald Trump's fans and supporters. He is, you know, in addition to his vast wealth, got enterprises and all sorts of faraway fun things like outer space, right? So Elon Musk is somebody who is known to sort of push the boundaries. And this is one where it could come with a little bit of hot water, right? U.S. law generally forbids paying somebody to vote, but Musk and his side think that they found a sort of workaround to that, to do a sort of sweepstakes for people who may take one or two actions that would be down the road towards suggesting a support towards Trump in critical places, right? You have to live in a critical battleground state. You have to sign a petition that broadly states that you are in favor of certain things Donald Trump is also in favor of. Does that get them around these potential legal challenges? I mean, that may be for a court to decide, but we are already hearing from some prominent Democrats that they think this is an issue that investigators ought to at least take a peek at.
Well, Derek, this, of course, to your point, brings up a lot of legal questions. But for an international audience, can you just highlight what the impact of a super PAC actually is on this race, and not to mention Elon Musk's own following on the results of this race?
Sure. The simplest version is the super PAC allows you to donate fantastic amounts of money to the general operation of pushing towards some political outcome you might like, right? You can't necessarily sit there and say, this is a whole truckload of money designed to particularly elect this person, but it can be done in all sorts of variety of ways that kind of get you about to that point. It would be sort of like saying you can't go out and make Coke, but you can go out and make Coke Zero, right? You know, there's all sorts of vagaries in U.S. election laws that get put right up until the possible limit. So in short version, what's happening here is that Elon Musk has the ability to kind of direct resources towards his overall goal of getting Donald Trump elected president, and he is certainly putting both his money and his time where his mouth is.
Derek, great stuff. Thank you very much indeed for the update. We greatly appreciate it. We are definitely in the final countdown into the election now. Derek Wallback joining us on US politics. I want to take a quick look at what is happening with the price of crude this morning. So down pretty sharply last week. We bounced a little bit this morning. We're not up by much. We're up by around 0.5%, as you can see on Brent and TI. But you need to see this in the context of what we saw last week, which was certainly a move lower, a fairly significant move lower in the price of crude. Geopolitics obviously needs to be folded into what we're watching here. Israel's military is taking aim now, we understand, at Hezbollah's financial arm in Lebanon. It's issued an evacuation warning to civilians. This as it seeks to hit the group's economic strongholds. The unit serves as Hezbollah's alternative banking system, allows the Iran-backed group to function in Lebanon. We've also got the hit from a Hezbollah drone near Benjamin Netanyahu's home over the weekend to factor into our thinking as well. Let's put it all together now and get an understanding of where we go from here. Joining us now from Dubai is our Middle East breaking news editor, Dana Kraish. Dana, talk to us about the kind of what appears to be a new phase in the Israeli attack on Hezbollah.
Right. We saw Israel yesterday started airstrikes against so-called Qard al-Hassan, which is a quasi-bank that belongs to Hezbollah, and this is part of the group's financial network. This, you can imagine, a few branches here and there, but mostly in areas where Hezbollah has a strong presence, like in the southern suburbs, like in the Bekaa and in South Lebanon. And these banks are mostly used by supporters to take out loans. You can put in against gold or heavy deposits, and you can take out an interest-free loan. It's a sort of an Islamic financing arm. And also the U.S. designated that as a terrorist organization, Hezbollah, and also that financial arm in 2021, and said that supporters and more people involved in this Qard al-Hassan association are using their personal accounts to cover up billions or actually millions of dollars that Hezbollah is funneling through the through the system. This is outside of the Lebanese banking and financial system, and they mostly deal in U.S. dollars. And we saw strikes, 11 strikes in Beirut's southern suburbs in less than an hour, targeting these branches that are mostly based in places like shopping centers and residential buildings.
So, Jada, so that's the activity that we're seeing the Israelis take in Lebanon. We understand the Israeli Security Cabinet met last night, and there's been a lot of talk, obviously, since the beginning of this month about whether we'd see this promised retaliatory attack on Iran. Any further news flow on that?
We're still waiting for that Israel retaliation. Israel has committed itself to retaliate against Iran. And after the drone from Lebanon penetrating Israeli airspace and reaching the private home of Prime Minister Benjamin Netanyahu, the Israeli cabinet met and they said that they are discussing ways to respond to Iran. And now we know the U.S. doesn't want them to strike oil facilities or nuclear facilities, but it seems that what Israel is saying is that they take into account what the U.S. wants, but at the end of the day, they will do what's best for Israel. So it seems that all options are still on the table despite U.S. intervention here. And of course, the region is on edge, and so are oil traders, perhaps, about how will Israel respond to Iran's attack on October 1st.
Bloomberg's Middle East breaking news editor Dana Kreisch, we thank you so much for bringing that into context. A really crucial and developing story. We go from the geopolitics to the corporate earnings next. Coming up, software giant SAP reports earnings later. We're going to dive into a preview of what to expect next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 46 minutes into a European session that shows a bit of divergence across Europe. We don't see huge moves in stocks this morning. We're waiting for some data later in the week around PMIs, the European growth story in focus. For FTSE, it's higher by 0.4%. The CAC is actually flat now, pulling itself back from earlier disappointment, and the DAX down 0.1%. Let's pivot to politics in Europe, because the Moldovan president, Maya Sandu, faced an unexpected setback as a referendum on joining the European Union was approved, but by a very, very slim margin. That defied pre-vote polls, which had showed a consistent majority in the former Soviet Republic, had backed accession. Joining us is Bloomberg's Bucharest reporter, Andra Timu. Andra, very good to speak to you. Thank you for coming to speak to us. So just over the border from where you are, over in Moldova, we've seen this backing then for EU membership, but with a really slim margin. Where does that leave the government in Moldova?
Yes, it was a very interesting night in Moldova the past evening, because everybody was expecting an approval for the EU referendum, and at some point analysts were also predicting a potential win from the second round for President Maya Sandu, but that unfortunately didn't happen. And basically this shows that Moldovans are almost equally split between the pro-European and pro-Russians. So this complicates things, especially considering that the President Maya Sandu will face a second round with a pro-Russian candidate 2 weeks from now, so on November 3rd. And as things stand now, she does have a 40 plus voter support, but she still, to win the election, she still needs to convince more voters, because she definitely needs to win the second round. The pro-Russian forces are also very powerful in Moldova. Moldova is a former Soviet republic who borders Ukraine and is home to a lot of Ukrainians now who fled the war. So it does have an geopolitical importance currently, hence the Russian intensification of its efforts to destabilize the country and to have the pro-Russian forces in Moldova play an important role in the politics there.
Andra, just for an international audience, can you explain the significance of Moldova to Russia? Why are they so adamant to have that influence?
Basically, Moldova is, from its position, it's very close to the to the territories in Ukraine that they control now. Plus, Russia still has a lot of troops and ammunition stored in Moldova's breakaway region of Transnistria. They also have another enclave in an autonomous region called Gagauzia, which is also pro-Russian. For years, they used Moldova's financial system to launder money. There have been several banking frauds in Moldova. So it's an important, from this perspective, that's why it's important for Russia.
And remains on a knife edge. Fascinating to see how close this vote is. Andra, thank you very much indeed. Andra Timu, our Bucharest reporter, joining us on the latest out of Moldova. Let's pivot back to the earnings story, which is certainly going to be a dominant theme throughout this week. A little later on today, we're going to get earnings from the software giant SAP. I think it's now Europe's biggest tech company. Tom McKenzie joins us now ahead of these numbers. The voice in my head says the second biggest. It changes on an almost day-by-day basis.
The voices in your head, guys.
I have many. Not all of them are right. So what are we looking at here? What are the key numbers? This is a cloud story.
It's a cloud story.
And it's different to ASML, which is the other company that's vying basically for this crown.
Yeah, there's the front end, the back end, so SML making the hardware, and then on the closer end in terms of where this is in the pipeline of those AI solutions, it is front-facing in terms of where enterprises deal with AI. It's the software that you sell into these enterprise units. And we are going to be looking at cloud. What they've been doing over recent quarters, and it's proven quite effective for them, is migrating their existing customers from on-premise software solutions to in the cloud. And that's proven profitable for SAP, and that effort continues. Yep. Cloud revenues expect to increase this quarter. The estimates are for an increase of about 25%. JP Morgan says, look, this third quarter could be a little challenged because of the macro environment. Longer term, medium term, they say they're pretty positive on the stock and the opportunities around SAP. But what it talks to is a tension, no doubt, playing out in boardrooms up and down the country, in Europe, in the US as well, as to how to spend on software at a time of slower global growth, more challenged global growth. How do you prioritise your spending on software? Do you continue to buy into software that has these AI capabilities, or do you pull back on some of this in terms of your concerns about CapEx spending? So that is going to be interesting in terms of what it indicates around boardroom decisions.
Yes, I remember for a time when the AI frenzy was sort of in its earliest days, we were seeing that some security sort of tech spending took a hit as a result around cybersecurity. So we'll watch that. Any clues around IT budgets? That's really interesting. And they seem to be doing pretty well still, as you say, on this kind of structural shift from on-premise to cloud. What about the AI theme then, and how is SAP managing to tilt that in their favour?
On two fronts. In January of this year, they came out with a restructuring plan that included some job losses, but as well investing in AI solutions for their own business to create efficiencies, but also ensuring they're embedding AI into the software, enterprise software that they sell to their clients. They say, the CEO at the time said they're going to be spending about €1 billion over 2 years to try and embed this. They've also really interestingly invested in some of the cutting-edge AI businesses out there, like Aleph Alpha, the creator of these models in Germany, and Cohere, which is a US-Canadian effort, as well as Anthropic as well. So it's been an investor in some of these key AI names. It's also partnered with Google's cloud unit as well to offer some solutions around this, particularly on data and AI. So it is trying to be on the front foot, this business, and trying to make sure that it's embedding within its own business, partnering with the right partners, they're creating these innovations. And again, it's going to be interesting in terms of the tell on that spend. So those numbers dropping after hours later today.
You mentioned Google and the partnership there. We're getting Google and Microsoft earnings next week.
Yeah.
Is this ever a precursor to what we might get from the bigger cloud players?
Well, it's going to be interesting in terms of that spend from the hyperscalers. So the question is, I mean, is it a question, really? Most analysts suggest that Microsoft and Alphabet are not scaling back that approximately $10 billion that they've spent already in terms of building out their data centers. SAP will be an indicator in terms of that enterprise demand that, of course, the likes of Microsoft and Alphabet are also playing into. So in terms of a nod to those earnings stateside, yes, this will be an indicator.
Thanks, Tom. Thanks for the update. Bloomberg's Tom McKenzie with the latest on the tech news flow that we still have to come. And tomorrow morning, we'll be speaking to SAP CFO Dominic Assam after those earnings. Tom, I think, probably having that interview in his show, 6:30 a.m. UK time. So we'll certainly focus in on that. Also tomorrow, thinking of tech themes, we'll bring you a conversation with the ASML CEO as part of the Bloomberg Tech Conference. You can watch that at 9 a.m. UK time. So a big focus on all things tech during tomorrow's programming across the board. Should we have a look at what else is ahead for the week?
There's plenty going on, for sure. Let's talk about the IMF summit, because I know this is something that Tom McKenzie was talking about in the previous hours, or in the previous programming, where, of course, debt is going to be front of the agenda, not to mention some of the questions around the election as well. How does that affect a lot of the EM story? That summit beginning today. Anna was talking there about the earnings story as well. Tesla, Boeing, Deutsche Bank. It is earnings palooza, earnings bonanza. You can pick your one. I like palooza. That's what we're going to see this week and going into next week as well. But for me, it goes back to the data on Thursday and Friday, where you do have the global PMIs on Thursday and the German IFO data on Friday. I don't even know what the highlight of this week is. There's so much going on.
20% of the S&P is reporting numbers, 16 trillion of market cap.
So guys on team earnings. Anna?
Yeah, no, I'm saying, focused on that earnings story.
So I think GE is going to be... So Boeing's going to be really interesting on Wednesday, but I think GE also on Tuesday is going to be fascinating, because you're going to get some indication of how the Boeing story is affecting the supply chain narrative as well. But you've also got a lot of defence companies out of the States this week as well reporting numbers. What are they going to be saying about their demand? That's been an area that's been really interesting. So I think that there's a number of kind of key sectors that I think are going to be worth watching out for.
Will there be new things out of Tesla? I mean, we just saw that big, hyped-up launch around the robo-taxi, and so we've kind of got that out of our system. Because often when we go into Tesla numbers, analysts are saying, well, it is about the numbers, but it's also about that big picture, autonomous driving future. Well, we kind of know that bit, don't we, a little bit more than maybe we do going into usual numbers. So, yeah.
Fine. I'll lean into the earnings. Deutsche Bank, then, I guess.
It's not binary. We don't have to choose, Kriti. We can do them all.
I feel like I have to. This is true. Deutsche Bank, I think the buyback story is going to be interesting with all these the banks. When are we going to see some of that dry powder for the stock?
What are they going to say about Commerzbank? What are they going to say? There's a lot of things.
Do you think they will say anything about Commerzbank?
I don't know, but that's going to be. I think that's going to be fascinating.
Yeah.
That's the story that's playing out in their market, isn't it?
And
I'm sure there will be questions.
And the rate story that so dominated the US bank earnings season.
True.
The fact that rates are going to be a little higher than we'd anticipated for a little longer than we'd anticipated.
In Europe as well, maybe not.
In Europe, maybe not so, but maybe the global story. How does that bump up against that European weakness? Yeah, that's going to be interesting.
I'd be curious to see, though, if there was a Orchel comment in there somewhere.
I'm sure they're watching it very carefully, and I'm sure they'll be asked about it as well. So I think that'll be an area of interest. UK banks are also reporting numbers this week, so it'd be interesting to see what they say about the budget, which I think will be fascinating as well. Tom's back in a minute.
Yes,
he can just basically stay there.
Tom's still around the desk because he's going to be anchoring The Pulse, which comes up next. That is it for the opening trade. The Pulse is up next. They'll keep you across these market moves. Feels like we're building towards the earnings stories through the rest of the week. The Stock 600 pretty flat, up 0.1%. The FTSE getting the best of the gains this morning. US futures also looking pretty flat this morning, or mixed. This is Bloomberg.